So we're going to get started with our first session, and I'm going to introduce our panelists. The gentleman sitting to my left is our leader. He's our CEO. It's Bob Dean from Metonic, who knows more about real estate than I will ever know. We also have Susie Cope, who's managing director at Lument. And on the very end, we have Aaron Eastman, who's portfolio manager at Avalon Capital Group. Obviously, three different, not industries, but different perspectives on the multifamily outlook. And I'm going to ask the questions and let them go. And so we're just going to get started. So first of all, I'm going to address this first one to Bob. But of all the potential types of real estate out there, whether it's commercial, industrial, et cetera, multifamily seems to be receiving the most interest in today's market. Bob, if you would, can you discuss your view on the multifamily market during this current cycle?
So I suppose it'll come as a great surprise if I say the status of multifamily housing is pretty terrific right now. But Metonic works from Sioux Falls, South Dakota, all the way through Beaumont, Texas. And then we've got a few markets that are on either side of that, but that's our core is, certainly Omaha, Des Moines, markets in and around there. We've recently done, some work in Sioux Falls and certainly have a pretty big presence in Texas. And so over the course of the past 18 months or so, if you go back 18 months ago and you think about the discussions that I was having with many of the folks in the room, and certainly panelists and Ron and others were having, is, what's going to happen, what happens next, what comes next. We certainly were nervous about whether or not residents were going to pay rent. What happens if they don't pay rent? How does this work in a world where everybody's working from home? And so we went through 18 months of kind of, wondering about how does this work and what's the next step around all of this and what comes next. And we're now sort of in that spot where, the Delta variant is messing around with us a little bit, but we're largely in the spot where we feel like we really know. And so I jotted down a few notes of, things that are certainly the case in Metonic's portfolio, but I think are the case regionally as well as nationally. And that's, our occupancies are plus 95%. I looked at our entire portfolio, north to south, east to west the other day, and most of our properties are plus 97% occupied. But our average average occupancy across the portfolio is 95, and that's really, really good. So if you're, thinking about like how do we generally underwrite for occupancy to be, we generally underwrite at like 92, 93%. We're hearing a lot that, occupancies are higher than that, not just at our properties, but also at competitor properties that we work with. And so you might wonder then, are people living in those homes but not paying rent? Well, that's actually not the case. When you actually look at it, our rent collections are almost as good as they would have been in a pre-COVID world. Slightly off, but where they're off, it's very location specific and problems that we can pretty easily solve. And so that's definitely the case in the Midwest. Probably slightly less so the case if you go towards the coast, but collections very, very strong. So the third indicator is, well, are people paying more rent today than they might have paid 18 months ago? And the truth is that rents are growing faster now than they have. And so I've been in multifamily since I was a teenager. Rents are growing faster, which is a very, very, very long time ago. Rents are growing faster now than they've ever grown before. So when we underwrite deals before we buy them, or we underwrite deals as we're building them, we generally think that rents on an annual basis will grow somewhere around 2%. In this part of the country, it's 2.5% would kind of be the average. Our average has been, if you go back a decade, our average has been 2.7% is what our kind of annual growth rate is on the rent side. But we typically underwrite 2% rent growth. So I went through our CoStar reports the other day and just looked at what they're projecting for rent growth, or what they're seeing in rent growth and products that are in their database. And so Omaha is growing at a 5% annual clip and has been for the last couple of years. Lincoln is growing at a 7% clip, really impressive. Kansas City is a 6% clip. Sioux Falls is a 6% clip. Denver's a 13% clip. The only one out of that was slightly out of the norm was Minneapolis. Minneapolis is growing just over 3%. And so when you look at Minneapolis, you say, well, it's 3%, that's disappointing. But that 3% is still higher than it probably was at any historical time. And you can do that if you go across the country. We're spending some time looking at markets in California, and we're spending some time thinking about a development project in California right now. And when you look at what rents are growing in the California markets, like Palm Springs, Riverside, San Bernardino, it's almost 15% on an annualized basis is how quickly rents are growing. Now, some of that's a function of the fact that occupancy is really good. There's not that much to rent, but that's definitely impressive that you got rents growing as quickly as we are. We're going to talk a lot more about this as the morning goes on. But Josh asked about, well, how's the new construction stuff going? So in our case, the 2 lease-ups that we had during COVID leased up faster than we projected them to. Latitude 41 ended up delivering 6 months ahead of schedule. Some of that was because of our construction guys did a really great job, but a lot of it was that our team did a good job, and consumers really demanded newer housing. I think that was a big deal. They were really looking for the types of amenities that we're offering in our new projects, and so very happy about that. Ravello, much the same way. I think Ravello is a story in and of itself. Our Ravello 192 project that's at 192nd and Pacific has just been the timing on that relative to COVID and how people are working nowadays has just been a really big deal. But our occupancies are really good in those. High demand on the newer products for sure. On the single family front, I don't do single family work, but my house is apparently worth 20% more than it was a year and a half ago. No idea how that's the case. I haven't done anything to it, but thanks, Jamie. Just screwed me up there. Just kidding. And so when you think about this, you're like, okay, well, so the multifamily world's on fire. Lots of great stuff going on there. Single family stuff, much the same way. So my, quick true story, my niece called me. My niece bought a house a few years ago, about 50th and Leavenworth in Omaha. A little 2-bedroom house, about 1,300 square feet. Wants to step up in her housing. She bought it for, I think, $115,000 a handful of years ago. Put it on the market at $179,000. She texted me her listing a couple of days ago because I'm in real estate and my family thinks I can answer any question relative to real estate. They really don't have any idea what I do. And so she texted me the other day and she said, what do you think? What do you think? And I said, well, I'll bet you before the day is out, you'll have a full price offer. And she said, oh, there's just no way that that's going to happen. I said, let's just wait and see. At 8 o'clock that night, she texted me. She had a full price offer with no contingencies at all. The only contingency was that the prospective buyer wanted to know by 11 o'clock as to whether or not the offer was accepted. And she said, what do I do? And I said, well, if it was me, I'd counter at $200,000. She didn't do that. The question she asked me, she said, is that legal? I said,
it has happened to me a few times. Apparently it is.
Yeah, apparently it's legal. And so everything from Class A, single family, luxury homes, starter homes, first time homes, homes that are building, rental, all of that stuff on the housing front is just really on fire. And there's lots of reasons for that. There's no indication that's slowing down. And so we think it's a really great time to be involved on the real estate side. There's no doubt that COVID has accelerated a bunch of trends that were already kind of appearing pre-COVID, but COVID's been definitely accelerant on the housing front all the way across that. It's an interesting time to be a part of the multifamily world because I think it's a fascinating time for consumers to be making decisions about how and where they want to live, how and where they want to work, where they're going to live at, if they're going to be working differently. I think there's all kinds of fascinating discussions that we're just really primed to be having in the very near future on all of those fronts.
Thanks, Bob. Susie, thank you for being here, first of all, traveling in from Eagle.
My hotel's been lovely, thank you.
Yeah, that's great. It's great. So you're a representative from one of the largest multifamily lenders in the country. What are your thoughts on the current multifamily market from a lender's perspective?
So, I think there's a lot of things that Bob touched on. Obviously the market's been fantastic and it continues to look fantastic. I've been thinking since 2009, 2010, when things started to get back and moving that I was going to get a break at some point, and it has not only yet to happen. We're looking to do more business in the fourth quarter than we did almost all of last year. It's been incredible how much, and especially coming from a position, like Bob said, with COVID, where, I mean, to many people in this room, we were freaking out a little bit, and we started putting reserves in place. I mean, Fannie, Freddie, the agencies, HUD, started putting reserves in place, not sure what was going to happen. There were issues with eviction moratoriums and everything like that. And I'm not saying that all of that is necessarily 100% behind us, but I think from a lending perspective, most of it is. And we are back to really aggressively lending on properties throughout the country. And so I'm actually currently live in Eagle, Colorado, and I've been there for quite a while. And it's, a small mountain town, western Colorado. And what I have seen is not only, the big coastal markets are doing fantastically, and we are lending aggressively both on interest-only basis and on pricing, and just trying as best we can to kind of keep up with the market. But I'm really seeing a ton of growth in the secondary and tertiary markets right now. I think Bob mentioned both, all the way from A-class multifamily all the way down to single family. I mean, especially in the mountains, and not only in Colorado. I mean, we've seen Montana, we've seen Idaho. We were talking about Idaho Falls last night. I'm a big fan of also Whitefish, Montana. I mean, there's just so many markets that people really haven't heard that much about that are just booming right now. And I think from a lending perspective, a lot of those markets that maybe 4 or 5 years ago, we would have been a little weary to go put money behind a 200-300 unit apartment complex. I think all of the agencies, Fannie, Freddie, HUD, as well as our balance sheet, are starting to get a lot more comfortable with it, especially as people are getting a lot more flexibility on where they can live, where they can work from. And so what we're seeing, and I know Metonic does a lot of those markets, especially in the Midwest, in terms of secondary, tertiary markets, we're seeing the growth with really astronomical numbers. And for us, it's really important. The numbers Bob was rattling off, I couldn't keep up with all of them, but I'll get the spreadsheet later. The growth numbers in terms of what you're seeing as percentage rent growth year over year. It's great not only from a return perspective as you're looking at potential investments, but it's also great from our perspective because we really take that information seriously and put it into how we look at lending on deals. So, if we're seeing 5, 6, 7% growth year over year, we're going to put that into our model to make sure that, if you put 10-year money on a deal, we lend you, $10 million for 10 years, we're going to see, and we're going to actually input those 5, 7, 10% rent growth numbers into the exit, which is in turn giving you more years of interest only and allowing us to get more aggressive on pricing. And so a lot of that has really helped dictate how much money you're getting on deals, how much leverage you're getting on deals, and ways to boost returns. So, I mean, across the board, I would say the market has been fantastic. Obviously, if you've been watching it all, where treasuries and pricing have gone, the 10-year hasn't totally been our friend the last few weeks. But we're still below, from a 10-year perspective, we're still below today where pricing was in April. And we're still at incredibly all-time low price. So, maybe things look a little different from 4 weeks ago. But, we also got a jobs report last Friday that we're hoping starts to take into account a little bit into pricing and bring that pricing down a little bit more. But, I mean, at the end of the day, we are very excited about what the next 12, 18 months has for the multifamily market. And, especially in those secondary, tertiary markets, that really haven't seen the same boom over the last decade that everything else has. So, I mean, we're excited, and I think there's a ton of opportunity.
So hear that, invest your money in multifamily, preferably with Metonic. Thanks, Susie. Aaron Eastman, he works with Avalon Capital Group, and Aaron, you're an active multifamily investor, and being in a family office, we'd love to hear your thoughts on multifamily investing and how you select which sponsors to work with.
Yeah, sounds good. So, I mean, just broadly, we approach multifamily as one piece of our real estate allocation in a well-balanced portfolio. So, I mean, first and foremost, that's really important. I think the other part when actually selecting a sponsor like Metonic, a key thing there is what has their success been before, what's their track record, and then is there anybody that can kind of vouch for them, quite frankly. I mean, that's how we entered the relationship. We, had got to know actually Scott Silverman through another contact who put us in contact with Bob. And even though we did Lakeshore as our first deal, it wasn't the first deal we looked at. And that's a key for us as a multifamily or as a family office is we generally take time to get to know people. And so, we'll work with you on a couple projects, but we rarely say yes to the first thing we look at with you. Because one, we want to see, how do you go through your entire process, start to finish? And generally, we're not seeing those beginning innings with you if we're kind of coming in the middle of a process or towards the end. And generally, as a family office, as I'm sure a lot of you can probably relate with, it takes us a while to get comfortable with new markets. And so Springfield, Missouri was no exception to that. I think we had started talking about Springfield in general probably 3 months before a deal was even on the table, just to start getting comfortable with what do the dynamics look like in this specific market. And so ultimately at the end of the day, it's getting to know somebody and having that personal relationship. Are they doing the things that they said they were going to do? Have they performed in the way that they said they were going to perform? And then I think the last piece of it as well is, when we get to those final stages of underwriting a deal, looking at potential returns, are the returns and expectations realistic, right? So when Bob mentioned, hey, we underwrite everything to about a 2% growth rate, but we've constantly performed at 2.7, we look at that as, hey, look, they're actually putting a conservative number on paper. What we're seeing in today's market is a lot of people who are taking these 5, 6, 7% rent growths and saying, oh yeah, we're going to have this forever in the future. And we immediately we'll just be like, no thanks, and walk away, because that one number is telling us you're not taking serious the implications of where this market is. We know where it is today, but we have no idea where it's going in the future. And the best thing that you can use kind of for that future potential is to look at your past successes and your past history. So that's kind of a roundabout way I think of answering that, but yeah.
Thanks, Aaron. Can you all still hear me? All right, great. So this is just for the panel generally. We've talked about how great the market looks, especially over the next 12 to 18 months, but we'd like to hear what some of the challenges are that each of you from your own perspective may think is looming, and also what are you excited about within the multifamily market? Anybody can take this.
Well, I'll start. So this is easiest to start than it is to come third, but so a couple of things that both these guys said we're spending a lot of time on is actually going to probably, so we're not the only sponsor to figure out that the multifamily world is a pretty great place to be and invest in. And so in response to that, we've had to probably go a little bit more tertiary than we typically would. We probably wouldn't have been in Sioux Falls a handful of years ago, but are in Sioux Falls now. We're actively really looking at Ames pretty hard and looking at other smaller markets to drive the returns where we think we can do that investors have become used to. And so I think you'll continue to see that for sure on the acquisition front as we go forward, and we're excited about that. We think there's some really great smaller communities that are really performing well relative to their bigger brethren, and there's a lot of people that are trying to move back into those markets again. So we'll continue to do that. A couple of things I'm excited about. I think there is a consumer move, what I would call a flight to quality, and so there's large groups of people that are looking to step up where they live at and how they choose to live in those places. So I using my niece as an example, she wants to step up from the house that she's in and bought a few years ago to something that's that's better than that. I think we noticed that trend quite a few years ago. I think that will continue to happen as time goes on, that consumers at all levels will look to step up on that front. The second thing I think is sort of exciting is from the housing side is this whole work from home concept that, Matonic owns some office buildings too, probably won't be great for our office buildings, but I think actually could be pretty great for a lot of our apartment communities, particularly some of the ones that we're thinking about developing and the manner in which we're developing them. Some proportion of that work from home crowd will be renters. We saw this, so Jeremy and Cassie and I were in California a couple of months ago, shopping markets in Riverside and San Bernardino, and all of those properties are full. Rents are growing at a crazy clip. But one of the things that we noticed was how well occupied the parking lot was in the day. And so that means that there's a lot of people working, but they're working from their home. There's a lot more of that probably on the coast and in places where there's a long drive back and forth to work or whatnot, but we certainly have a good amount of that here as well, and I think that'll be sticky for some period of time. And so we're excited about, on our multifamily side, about how that impacts, how we think about development, our townhouse style developments we're working on. We're excited about that. A couple of quick concerns. Property taxes, it's a concern. I think the county assessor sees the same things that we're seeing, and they're equally proud of our values. And so, working that through with them, I think will be a growing challenge and something that we'll have to spend some time on, on an annualized basis. Not any different than how we always have, but I think that, that will be interesting. It's an interesting time on that front, and that a lot of these counties have tons of money that they've gotten from the federal government. There was like COVID relief money that they're trying to figure out a way to spend. But at the same time, they're, still going about raising values just like they always have. And I think in places in the Midwest where we largely do business at, I think that will continue to be something we'll have to fight off and work through. The second one that's a little bit sneaky is just insurance rates. Our property insurance rates have continued to go up in response to just a lot of the storms that we've had in the Midwest. We've got a pretty healthy exposure of real estate in Texas, and we kind of forget about that freeze storm they had in Texas a couple of years ago that had some impact on the insurance markets. Our wind hail stuff around here is certainly had some impacts on our markets in this space, and so our premiums are up some. So we're spending a fair amount of time thinking about how do we think about deductibles and reserves for deductibles versus premium increases and that kind of thing. And so I think that will kind of continue to be a concern for us as we go forward.
I think I experienced your windstorms last night. I wasn't really sure what was going on at about 2 o'clock in the morning. So, I agree. We're seeing the same things on taxes, insurance. I would also say, to the point made earlier relative to sponsorship, I think that's something that we are taking very seriously right now. As aggressive and as we're getting in some of the secondary, tertiary markets, I think for us, we're seeing a lot of people go into some of those markets that maybe haven't owned multifamily before or aren't experienced with those specific markets. And I think that that's something we take seriously. We do a lot of business with Matonic, and I think that goes a long way for us in terms of when we're analyzing deals and we're looking at deals that we want to lend on. Having somebody who is going into secondary, tertiary markets, who has a handle on management, who understands what it takes to go into some of those markets, understands how to analyze taxes. We spend a tremendous amount of time on my team just analyzing taxes before we even get to throwing out numbers. Because a lot of times we'll get people that'll send us a deal and they've analyzed a deal, they are going into best and final, and we think they're, $150,000, $200,000, $300,000 off on what taxes are going to be, which really shows us that maybe they haven't done the work before. And so we take sponsorship really seriously. So not only do we look at the fact that you have a resume where you've been in multifamily before, maybe you've run a company, maybe you've worked on the management side, But to us, it's equally as important to have a bunch of real estate that you're actively owning, because we see that there's a distinct line between the two, right? Actually having had experience owning, or partners that you're in the deal with have experience owning, is very important to us. And not only for us as the lender, but also with Fannie, Freddie in particular, you're also seeing experienced owners and operators getting better pricing on deals, getting more leverage on deals, and getting more interest only than you do for somebody who's just coming out the gate, because we know that if the market does turn or something does happen or insurance goes up, which we've seen all over the board right now, they know how to work through that and manage through it. And so, that's one of the things that I think is probably most important. And Fannie and Freddie take that really seriously, and they take repeat sponsorship very seriously too. So when they look at a deal, so we look at the deal, we work with them to kind of come to final terms. The first question I always get is, well, show me a list of deals that we've done with them, or maybe they haven't done with Freddie, but they've done with Fannie, and their experience. And then we're also taking their entire real estate owned schedule and all of their expenses and looking at them compared to how we're underwriting that particular deal. And so I think for us, although we're very excited about the secondary, tertiary market move that I think we're seeing across the country, we also want to make sure that the sponsorship that's coming into us with those deals has the experience to do it. I think that's probably one of the biggest challenges, but upsides depending on who you are right now.
Yeah, and maybe just to start off, piggybacking off of that, I think the property management side of things is extremely important, and it's one of the biggest challenges out there right now, especially as you get into these tertiary markets. I think one of the things you see is these property management groups that have operated in fairly small communities. There may be one community focus. They do okay, but they don't have kind of the experience, and they're maybe not as innovative as some of the other kind of either big property managers or somebody who has experience in multiple markets. And I think even at the site, where we see a huge bifurcation in who's actually, that manager on site day to day. You've got, kind of two class of people as we look at it. One who's kind of reactive. Hey, somebody came in the door, somebody emailed me, I called them back. I did a virtual tour. Okay, great. But then you also have, the individual who's like, yeah, I called a bunch of people and I'm working with that employer across the street. And, they're going out and doing a whole different level of sourcing strategy where you're not just waiting for apartments.com to send you a lead. And quite frankly, we feel like a lot of people in that property management space are just relying on apartments.com or whoever to bring them all of their leads. And so I think that's a huge challenge as we go into these markets is, do you have the right property manager in place to actually get you to the returns that you want to have? And those returns are really keeping it full and making sure people understand the value that they're getting out of the property as a whole. The other thing I'd say, we talked a bit about just, the total market, but one of the challenges I see out there is just there's this huge over exuberance for building right now. Everybody wants to develop something. There's cranes and equipment going everywhere. I'm a little bit worried about how fast in some of these tertiary markets that snaps back the demand that we're seeing. Yeah, there's enough wiggle room right now, but Sioux Falls is a market that we follow closely. Earlier this summer, so MSA of about 250,000 people, for those of you that don't know the market, there was less than 20 houses on the market at one point this summer. That's a record low, probably something we'll never see again, but just, so people are seeing that and they're saying, hey, we should build all these big apartment complexes and there's lots of land and hey, we can do it fairly cheap, and it pencils out. But once you start looking at how many apartments you actually need and how many are already in the pipeline, we think some of those markets are already being overbuilt. People just don't know it yet. And so in a year or two, as those start leasing up, you're not going to see the same, hey, we are pre-leased in months. It might take some years. And so I think that might shake some weak hands out of here. And I think from a lending perspective, you hit the nail on the head. We're seeing people who have no experience being a sponsor, doing that construction before going in and just, hey, we raised some capital and everybody's flush with cash right now. And so they're looking for a place to put it. I mean, bonds aren't hardly returning anything. Equities feel like they're at an all-time high. And where's the next natural place for a lot of people to go? It's real estate. And it may seem good right now, but you really have to understand the markets you're getting into and what those potentials may be, because there's a ton of challenges out there right now. Maybe switch over to some happy news or some exciting stuff. What I'm most excited about right now is how technology may change the whole way that we look at multifamily. It's already starting to change how leasing is occurring. Virtual leases with Zoom. We're seeing people who may live on one coast or the other that are moving into these markets. It's a good way for them to see the property, see the apartment before they actually get there and show up. And generally that helps create a stickier customer as well. I think the other thing that's helping that is building communities. And again, this goes back to that property manager. We're seeing the really successful property managers build a community versus just, hey, you're gonna live here, 50% of you are leaving after a year, most of you are gone by 2 years. We're starting to see people who are really good at the property management, keeping people for 5, 6, 10 years, and they're making it a home, not just an apartment. And so I think if you can thread that needle, if you can really find ways to engage the community and keep more people there and keep neighbors knowing neighbors, you're gonna have better success in the future. And that's one thing that I'm really excited about. And one thing that I'll add maybe to the question, a third part, since I went last, and I'll take a little liberty here. What I'm most interested in is how COVID is ultimately gonna impact our long-term kind of potential and impacts of what do we need to see for space, where are people ultimately living, is work from home a permanent trend? This could be a challenge or an opportunity depending on how it goes. The fact that 18 months after COVID hit, this is really the first in-person conference that any of us have done, I think goes to speak, people are anxious to get back out, but they're not so anxious to maybe give up their work from home life. They're maybe not so anxious to do a few other things. And so I think that's one thing that I have a lot of just question marks around in general is what are the long-term impacts of what do we see the changes with COVID ultimately going to do to the multifamily market?
Well, and I think that the technology kind of helps allow that more so. I mean, I've been on panels this year. They've been on Zoom. I got to tell you, I probably spend more than my fair share of time figuring out what's behind me when I'm on the camera. And then, I mean, we learned, Bob was a great partner and we're glad to have that first inspection behind us. But I mean, we do Zoom inspections now at properties. So we had to start it when COVID. I think we actually were the first Zoom inspection. And bless Bob who had to deal with the first Zoom inspection, but now we've gotten it figured out. And I mean, so that technology itself and the whole COVID world has allowed us to do things that we weren't able to do or no one was comfortable considering 10 years ago.
And could that speed up the closing process, cost? There could be some efficiencies ultimately, and that could be benefit for everyone.
Yeah, so just to wrap that up, so for a very technology challenged person to figure out how to do a Zoom inspection on a property in Sioux City, the fact that we got that done was sort of amazing. I'm laughing about it now. At the time, I certainly was not, but it was really fun to do. I do want to give a bit of a shout out. So Selden Company is our property manager on almost all of our multifamily stuff. They've done an amazing job. They're all across the Midwest. They're all over the place now. I think they manage 22,000 units or something like that. And they're in our bigger markets, our smaller markets, our Texas markets, all of those things. But their response during COVID has been nothing short of amazing. The teamwork they've done, the staff that they've done, the way that they partnered with our asset managers has been really just terrific. And I certainly spent a lot of time at Selden, really proud of my time there. But they've been really, really terrific on all the asset classes that we've got. And it definitely has been a time of massive disruption on their front. I remember Alicia Clark is the CEO of Selden Company now, and probably like March 15th or something like that, I called her and said, of 2020, I called and said, well, what do you think? Like, what are you going to do? And she said, well, the site managers and the maintenance guys have to go to work. And they have to be there. They have to provide service to the people that are living in their buildings. And they did that, and they did an amazing job with that. I'm really, really proud of the work that they've done.
Well, thank you all. That was informative and filled up the time. So just a reminder, we have a chance to ask questions at the very end. So if you had some questions for any of the panelists, right now, jot them down and save them for later. But we're gonna exit and have the next panelists come up, but let's give them a hand. Thank you all.